Good morning, everyone, and welcome to Coffee and Conversations with AMR Elite Realtors with Taylor Properties. We are so excited this morning to see everybody. How are you doing?
Good morning. Good morning.
So this morning we
Good
have
morning.
with us Mr. Adam Backus of Acela Mortgage. Did I say the whole thing right? Acela Mortgage.
You can drop the partners part off, make it easy.
Okay. And he is going to talk with us about what are 203K loans, but they're also renovation loans is the correct name, right? So he'll give us all the info we need. But Mr. Adam, I'm sorry, I didn't introduce myself. I'm Alicia Richardson. I am the associate broker here at AMR Elite Realtors with Taylor Properties, and I have with me Miss
Juanita Winky Kennedy, and I'm associate broker here at AMR Elite Realtors with Taylor Properties.
Yes, and we have Adam.
Good morning, Adam.
Good morning, ladies. Thank you for having me today. Thank you for the nice introduction. You guys are looking awesome today. So yeah, thanks again for having me. Just a quick background. I've been in the mortgage business now for 20 years. So of course I've been through the roller coaster ride, and there was one in the 2000s, and now we're on one right now. So
right.
Seen a lot, battle tested. And part of the experience I had over those 20 years, especially coming out of the housing bubble that we had back in the late 2000s, one of the things we experienced then is when we had a flood of distressed property in the market. I really got into the renovation loans. A lot of the properties that were for sale back then had property issues. And the only way to acquire those homes was if you had a renovation loan. So at a former company of mine, they wanted me to become a renovation specialist. So on top of being in the mortgage business now for 20 years, I have been specializing in renovation loans since right around 2010. So almost 13 years now, I've been specializing in these. So have a ton of experience with them. And it's something I take pride in doing. They are tricky loans. We don't get paid extra for these loans. They're just extra work. But I look at it as opportunities for everybody. And that's why I am a renovation specialist. And that's why I call myself Mr. 203K.
203K, that's right.
All right, Mr. 203K.
Yep, I'm
all
here.
Right, I like
here
it.
in the
I
flesh.
Like it. All right, Adam. So let me ask you this question. What advantages when using the renovation / 203K loans to purchase a home? Give us some advantages on doing that when the home needs a complete renovation, like a total overhaul.
Couple things there. I like how you put it. You said 203K and renovation. So a lot of folks in the business automatically associate, when you hear a renovation loan, they automatically think, well, 203K loan, it's a 203K loan. Okay. Well, just to clarify that, 203K is actually an FHA product for renovation. So the common agencies that provide standard mortgages that we're used to seeing are HUD, which they control FHA. You've got Fannie Mae and Freddie Mac, which are conventional, the companies that run conventional underwriting and conventional guidelines. And then you have the VA, Veterans Administration, which does the VA loans, and you have USDA, which does the USDA rural housing. Okay. So all of them have standard mortgage products, but all of them also have renovation products too. Okay. So each one has their own version of a renovation loan. Now, does every lender offer those renovation loans? Not at all. So in the industry, a lot of folks, they're so used to seeing the FHA 203K that they associate and they think that's basically what they're all called, but they're not. The 203K is specifically an FHA product. Fannie Mae has their own product. It's called the Home Style. Freddie Mac has it. Theirs is called Choice Renovation. VA has a VA rehab loan, and USDA has a USDA renovation loan. Okay. Most lenders don't offer them. I, of course, have all of them. Okay. So as far as the advantages, we'll just think of it that way. Let's look at a macro level with those agencies. What do we know about VA? That's for veterans only, qualified veterans only. Well, what's the advantage of VA? Zero down payment. So now we have a solution where normally most mortgage companies, they have to go to a 203K, which requires a down payment and mortgage insurance for a veteran. They don't have the VA renovation product. I have the VA renovation product, which now you've got no down payment on a fixer upper, and no mortgage insurance. You get to use your VA eligibility. So you're not stuck just looking at a turnkey house. You can look at a fixer upper and use your VA eligibility and not need a down payment. Okay. It's a beautiful setup. Same with USDA, our rural folks out there that are trying to buy in rural areas. One of the advantages of USDA financing is zero down payment and very, very low mortgage insurance. Now we have a solution where they can look at a fixer upper, okay, still have that advantage of zero down payment. Okay. So USDA doesn't care. As long as you fit in the blueprint of what they allow, you can acquire a fixer upper and not need any down payment. Okay. So those are right there, just in general, are two examples of an advantage. Now, if we dig down a little deeper and we start looking at property, I mean, you gals tell me, I mean, not every area has issues, but there's inventory issues, right? We have inventory challenges.
Yes, we do right now.
Yes.
Right, especially at the lower price points and lower loan amounts. I mean, with the rates going up the last year, now people's borrowing power has gone down. So they can't get as much as they could get before. I mean, I think they're down about 20 to 30% of what they could borrow last year this time than they can this year at this time. So now they have to look, if they're trying to buy, look at opportunities. And now we can start entertaining fixer uppers. Now you can start looking at houses that, and this is not just for simple cosmetic stuff either, because a lot of folks out there think that, oh, it can only be like a $35,000 project or, just basic, repair, replace type stuff. No, we can do full scale remodels across the board with any of these products. Okay. Now the VA product is a little bit stricter on the type of work than the other ones are. But at the end of the day, someone could go find let's say they could borrow $300,000 on a reno loan. They could go find $100,000 house that was completely trashed, and they could fully remodel that property as long as they could fit the amount they're borrowing. They could do, like, let's say the renovations were $200,000, the property was $100,000. Hey, that's in the $300,000. So it's the renovation amount is substantial. It's more than what they're paying for the house, but they could go after a property. Maybe it had fire damage, maybe it had flood damage, maybe it had mold issues, or maybe there's just so many things that you can do with it. And so folks can now, and I think for you as realtors, maybe when you're having those conversations, you could expand and say, hey, have you thought about this? I know you want this, but have you thought about it? Maybe they want a house that's a 3-2, but they can only find a 3-1 or a 2-2-1. Maybe we do a renovation loan to get an extra bedroom, get an extra bathroom. So much versatility that you can do with these.
That's good information. That's really good information.
Yes.
So my question is, even with what you're saying and how you have like USDA is zero down, VA is zero down, right? So I know that USDA or most renovation loans, when I'm doing them, I'm talking to a purchaser, just a normal purchaser. But then you have investors that, question using the renovation loans. How does it work for them with down payment? Like, what is the down payment on it? Because I know at one time I was told, hey, when you do a 203K loan, however much the repairs are, that's what you have to put down. That doesn't even make sense. but
not the case.
And that's what a lot of people are thinking, that you got to put this lump sum to cover the contractors. And how does all of that work with the down payment with the purchaser, normal purchaser, and an investor?
So a couple things, just in general, the structuring of a renovation loan, a true renovation loan is, and we're looking at it from a purchase standpoint, because we can do these on refinances, of course, people that already own. Okay. So, but let's just focus on the purchase aspect. So they're buying a house, and let's go back to that same example. Let's say it's a $100,000 property and they're going to do 200,000. We'll just call it 200,000 in total work. The hard cost and the soft cost. You have a $300,000 total cost. So the down payment isn't based off the 100,000. The down payment is based off the 300,000. So if it's VA, zero. If it's USDA, zero. If it's FHA, it's 3.5% of 300, which is 10,500. And then if it's conventional, if they can get away with 3%, they qualify for that, then that would only be 9,000. If it was a 5% down, and again, these are all owner occupied, okay, that would be 15,000. So you say the savings come from the amount of work that you're financing. Okay, number one. Now we flip over to the investor side. All the ones that we've talked about mainly have been FHA, USDA, and VA. Those are all owner occupied. So
Okay.
the borrower has to live in one of those in a unit in order to qualify for that type of financing in general.
Right.
Now we flip over to Fannie Mae and Freddie Mac, which is of course conventional. Conventional allows owner occupied, second home, and investment. So you basically have two non-owner occupied situations there where you can leverage and use their product to acquire a second home or acquire investment property and do a renovation with it. The down payments change. Okay. Now I'm going to kind of veer off a little bit here in a second on some of the on what the Federal Housing Finance Administration has done, but in general, Fannie Mae and Freddie Mac both allow on a second home 10% down, okay, and 15% down on a 1-unit investment property, okay? So 1-unit second home, 1-unit investment property, the minimum down payments are 10 or 15% respectively. Now that's the guideline. Unfortunately, the way that they've impacted the way interest rates get priced up on those types of properties, it makes it very difficult to get in with the minimum down payment right now because of how things get structured and what we call loan level price adjustments. They basically, Fannie and Freddie, set up these adjustments. Like there's adjustments for credit score, there's adjustments for, whether it's a condo, there's adjustments for loan to value. Well, they came in and said, well, we're going to add some adjustments that you lenders have to pass on, that it's going to basically cost more on the rate side to get a second home or investment property. Basically, what they did was they slowed down the amount of finance properties are doing for those types of transactions. So at the end of the day, they do allow 10 to 15, but when you price it all up, you're probably going to have to put more down, okay? More like 20 to 25% down. But again, it's of the total cost. So in that same $300,000 example, if they had to put down 20%, that would be 60 grand. So 60 grand down, but they're financing a $100,000 house with 200,000 in renovation. So they're basically covering, in a nutshell, some of their renovation costs in a sense, but they're financing the rest. So there's still a ton of savings. Okay. So that's how that works. Now I'm flipping over. If we get outside of the conforming loan products, we get into hard money and some basically hard money setups. I actually have products where investors can do fix and flips, or they can do investor build. They can build a house. And I have some hard money financing for that. And that's where it's going to get more of a loan to cost analysis. It falls outside of the standard loan to value and standard guidelines, but you could potentially get in maybe with only 10% down in those situations, 10% of the total cost. So in a sense, folks that think you have to pay all your renovations on a renovation type loan, that's not necessarily the case. Even in the investor world, even if you get outside of the standard renovation mortgages and get into hard money, it may not be the case. You might be able to get a little down payment. Okay.
That's good to know.
Yeah.
Yep.
Okay, so my question is, do you have to acquire a contractor before you decide to purchase one? And does Acela Mortgage provide those kind of contractors that an investor could work with to actually purchase a renovation or a 203K?
So we'll just focus on the standard renovation programs, the Fannie, Freddie, FHA, VA, USDA, any lender, and this falls under each agency's guidelines. We are required to vet the contractor. Okay. The buyer chooses the one they want. Okay. They're going to do their own vetting. They're going to probably go to you for a recommendation or friends or something like that, Angie's List, whatever it might be. And they're going to find a contractor they want to work with. Then our job is to make sure they meet the requirements, which they have to be licensed in the state that the property is in. They have to have a track record of doing work in the last 12 months of either a similar project or greater project. Okay. And have the proper insurance. They're going to provide a resume profile form. We're going to get copies of their license. We're going to get their insurance declarations. And then there's going to be some back end processes, a D&B report. We're going to do like lien and judgment, judgments, anything like that, public record search. But once they pass that, they're good to be the contractor. Now, every lender out there keeps a list of who's been approved,
Right.
but we don't share a list and say, go use these contractors. That is a humongous conflict of interest. Okay. Because if we end up recommending a contractor and they don't fulfill, then who's going to get sued?
You.
Yeah, well,
Mortgage
I would guess
company.
so.
Okay. Because we're the ones with the
I would
money.
guess so.
Yeah.
Yeah.
So
Yeah,
huge
we don't
conflict of
recommend
interest there.
contractors either.
Right. You know, you guys have the ability to say, hey, you know, I've seen this one do this. I personally will say, like, oh yeah, you know, I've heard of this one. Or look, if you really need somebody, you know, give them a call. Like, but I'm not saying go use this one. You got to use this one.
Yeah,
But you want
right,
to call and talk
right.
to them and you like them, be my guest. But I'm not referring them, and I'm not saying this is the one you have to use. You know, so so yeah, to answer your question, yes, there is. We keep track, but we do not share a list or encourage or tell folks who they have to use. We just have to make sure they meet the requirements of the loan product.
Okay, that's good
It's
to
pretty
know.
basic though. It used to
Okay.
be back in the day, like when I was working for Wells Fargo, they wanted tax returns, they wanted corporate, they wanted personal, they wanted a certificate of good standing from the state of Maryland to make sure their taxes were. It was horrible. Personal credit, it's not like that anymore. It's so much
Wow.
more contractor friendly that, you know, contractors are involved with these a whole heck of a lot more.
Yeah.
They've
Okay,
come a
good to
long
know.
way.
So you kind of answered one of the questions I had, or my next question, but I'm gonna change it up a little bit. So, do you feel like you see more purchasers using 203K renovation loans than you do investors? Because I think sometimes purchasers feel like it's too much trouble, because they don't understand the whole package, and it's the fear of feeling like, oh, I gotta, you know, babysit this person to make sure they're doing it right. So they kind of run from it. And I see investors, you know, I don't really see investors using that product a lot. So I'm just wondering, who do you see use the most of that product?
That's a good question. So again, just because it's offered doesn't mean it gets used, right?
Right,
So
right.
I think if let's talk about the home owner, someone who's actually going to live and occupy the home that they're buying.
Mhm.
So, and I think you meant that when you said purchaser, right?
Right,
So,
right.
so I think you hit the nail on the head. They want ease and simplicity.
Right.
Okay. And these are not simple. Now, also there's a lot of lenders out there and loan officers out there that are not experienced with these. Their company has the product, and you cannot treat one of these like a regular mortgage. You have to
Right.
manage these like a project manager, which is kind of what I am when I'm on one of these types of transactions, because I'll have to interface with the contractor. I got to know how to talk. I got to talk with them, you know, otherwise they're gonna be suspect about whether I'm going to be doing the right thing for them. You got to have the contractors on board. They have to feel comfortable. So you got to talk with them. And then there's consultants involved. You know,
Mhm.
any loan officer has to understand how to interface with all these, and you only get that by experience. So I think buyers are afraid of it because they're not even getting to me yet to talk with them and say, hey, have you heard about this? You know, a realtor they might be spooked off of it. They might have had a bad experience. They might have had a listing that went south and that the buyer had a 203K because the lender didn't know what they were doing, you know?
Mhm.
So you have this negative perception of these loans. So the only people telling the buyers about them are us, really, you know, unless they go on the internet and they find a whole hodgepodge of information out there, and it's probably similar. They're just suspect of doing it because it is tricky. You know, the only thing we're really doing on these loans is giving the money to do the work, tying it to a mortgage. It's still the house they're picking out. It's
Mhm.
still the work they want to do to the house, or that has to be done. It's still their relationship with the contractor they choose. So it is a lot extra. Okay. And you have to be well prepared to do this, have the right property, have the right situation, have the right people, and you can make those work. Now, investors is different because most investors, they have money, they have credit, but they're also looking for ease, simplicity, and speed. That's where hard money can,
Right.
from an investor standpoint, is more favorable because they don't have to go through as many hoops. But it's hard for a first time investor to get into hard money. They're usually not as favorable. They usually
Absolutely.
have extra conditions. They use more money. they're going to be scrutinized more because that bank or lender doesn't want to lose out on this. They want to make sure it's these people know what they're getting into. Okay. So investors, especially experienced one, tend to stay away from the Fannie and Freddie renovation loan model just because of that. Because if you think about it, it's a Fannie and Freddie conventional loan. We got credit requirements you got to have, minimum credit scores, minimum down. There's all kinds of different levels. You can't close in an LLC. There's different things that are just not favorable for true investors that are either trying to fix and flip, because a lot of investors are not trying to fix and hold. They're trying to fix and flip, which you can do with the Fannie and Freddie renovation loans. There's no restriction for it. Inherently, we're assuming you're holding it because it's a 30-year note in most cases, but there's no stipulation that you can't use it as a flip product. But that's the hard money is more favorable for investors because you get in, get out, and you're usually trying to get speed, get your money quick, and have more control and get that property back to market as quick as possible. Okay.
I heard you say you cannot purchase, you can't use a renovation loan with the LLC. Can you use it with like a trust, a family trust? Can the trust purchase?
So couple things. So all the standard, and when I say renovation, standard renovation mortgage. So I'm not talking hard money because hard money is short term.
Right, that's different.
It's really not a mortgage. It's a short-term loan. But it's, with the standard mortgages, we're all following the same underwriting guidelines. So Fannie, Freddie, HUD, they all say no LLC. So you can't close in the name of an LLC. It's a personal guarantee. You're the one that's your personal credit, your personal name, but they do allow revocable trusts, inter vivos trusts. You can technically close on that as that. Okay. So if the family has some sort of a trust set up, it can be titled in that manner. Okay. Now, when it goes down, like what I always say, the investor renovation loans that I have, the standard ones, the Fannie and Freddie ones, what they're nice for is either a first timer because you have the security of a 30-year fixed note. You don't have a short-term 6, 9, 12-month hard money loan at high rate, high points. You don't have that risk, that you take away an element of risk. So if you have the credit for it and you have the assets for it, it's a good way to get in. Plus, it's good to get in as a buy, fix, and hold. If somebody wants to generate a rental portfolio, those could be very good products to go with because you have the 30-year note. Okay. So it just depends on where the buyer, this particular client, is coming from. Are they coming from a flip standpoint? Are they coming from a hold standpoint? What are they trying to do? And luckily now, I just recently have the ability to do either. We can do flips, we can do investor new construction, and I even have investor acquisition that has no rehab involved, but I have an outside the box kind of financing that doesn't fall under the Fannie, Freddie, HUD, all that stuff. Okay. So we can cover different paths.
Okay, good. And so my final question for you is, are 203K loans or renovation loans offered at a higher interest rate? I wanted to know, is there a prepayment penalty? And should you select these types of loans to do a flip?
So the interest rates are always going to be higher. So in a nutshell, let's talk about government rates versus conventional rates, just to start there. So government are FHA, USDA, VA, conventional, Fannie, Freddie. Conventional always has higher rates than government. Doesn't matter. They're always going to be higher in general. So now let's move that over. So renovation is going to be an added risk level. Okay. Anytime you have risk added on, the only way a lender can really offset risk is by hitting them with a higher interest rate. Okay. So the typical spread on, I'm seeing it could be given the day, given the credit score, you could see a 0.5% to a full percent variation. Okay. Just kind of depends. It can be really close, a close delta, or it could be different. Usually the credit score has a lot to do with it being a big variant, especially on conventional. Okay. Conventional looks at credit a whole lot, the credit score impacts interest rate pricing a lot more tighter than it does on the government side. Okay. So again, the interest rate could be anywhere from potentially a 0.5% to a full percent different in a standard rate. So it's something that has to be considered. It does impact borrowing power. When I pre-qualify somebody for this, and I have a feeling they're going to be in that price point where they're going to have to look at fixer uppers, or if they automatically want to, I'm doing two different numbers. I'm doing, here's what you can borrow with a turnkey, and here's what you can borrow for a reno. So now you have your targets, okay? And that helps you guys with the search. So you know, if you start looking down the road for a fixer upper, well, if they can qualify at 300,000 on a fixer upper, well, we have to make sure we find home prices that are down well below that. And depending on the scope of work, what's going to potentially need to be done, that there's enough room left that they can finance and get the mortgage for that transaction. Okay. Never a prepayment penalty on any of the, we'll call them conforming mortgages. Fannie, Freddie, VA, HUD, USDA, never a prepayment penalty. Okay. Only time you see prepayment penalties now is when you get outside to what we call non-QM, non-qualified mortgages. Those are your bank statement programs, your 1099 programs, your ITINs. You might see some
no-doc loans.
Yeah, the exotic ones. You might see some prepayment penalties on there because they don't fall inside of the conforming mortgage rules. Okay. And then I think, what was the last part of what you'd asked?
Should you use those type of loans to, do a flip?
Flip.
So you kind of spoke to that a little bit already.
A little bit, but the direct question is, you can't really, like, there's really no in writing of, hey, you've got to retain a property for so long. Okay. But you got to be very careful, especially if you're using an owner occupied product like FHA, VA, and USDA. If you're going and acquiring one, number one, you got to live in it. Okay. So you got to state on your application. So you're not going to commit loan fraud. You should live in the house. That's what you put on your application.
Exactly.
I didn't put it on there. Borrower's the one that put it on there, right? You said you're going to live there. So is anybody going to come knocking on the door 6 months later to see if you live there? No. But at the end of the day, you're the one that's putting and attesting that you're not going to commit fraud. So you can technically go into this, but no one says that. What if you bought a fixer upper and you lived in that house and maybe you didn't like the neighborhood? Maybe some wife got pregnant. I don't know. Whatever happened, your something changed in your life. Now that house doesn't meet your needs. Okay. There's no restriction on how long you have to live there. You could technically sell or hold and rent it back and go buy your next property if you could qualify for a next one. Okay. So you could do that. But what an underwriter is going to start seeing, if you're using FHA, for example, and you're living in a house for 6 months and then fixing up, selling it, and then going find another fixer up or fixing that up and living there for a year and then selling. If they start seeing you doing this as a pattern, they might think you're trying to leverage products to build an investment portfolio. But it's more of an underwriting thing than it is an actual guideline. It's an underwriter looking at it saying, well, what do you got going on here? But at the end of the day, you're probably going to they may ask a question of why you're continuing to do this. You could just say, I didn't like the neighborhood. My family size changed. My job relocated me, whatever it might be. Those are honest things. But as far as a true flip, like if it was an investor that wasn't going to live there and they were automatically going to fix and sell, yeah, they could technically do this. The only concern about it is if, with lenders, any commission we paid, in some cases, you could get an early payoff default or an early payoff notice. If that mortgage gets sold too quick, we might have to pay back our commission. So that's a conversation I have with any investors that are trying to leverage any of my products and try to do it as a flip. Okay. You got to be very careful because I don't do loans for free.
I get it. I get it.
All right.
So I have another quick question. So right now it seems like in most places, especially Prince George's County, most of the condos are not FHA qualified. And then some of them need some love. I call it love when they need renovations, right? So are you able to do a conventional renovation loan for a condo?
So yes. So condos are allowed across the board. Okay. Even allowed. USDA. Believe there's some rural areas that have condos, so each one of them is okay, but each one of them has a different way of verifying and approving the condo as a part of this deal. FHA is the strictest. FHA has a 2-level. They have the overall project has to already be approved. Okay. And then they go through the lender questionnaire during the approval to see where the health of the condo is. And FHA is pretty strict. Their delinquency rates are a little tougher. They look at 30-day or more and have that 15% concentration. Whereas conventional, the only time that Fannie and Freddie are really involved in the project itself is when it's built. Okay. But after that, anytime someone wants to get financing and wants to use Fannie or Freddie conventional in a condo, you do the lender questionnaire. And assuming you have to do the full questionnaire, okay, because there are streamline options,
Right.
but if they do the full questionnaire, they're still looking at delinquency rates, the number one thing that causes a fail. Okay,
Right.
delinquency rate on the dues. So and believe me, I think I'm still speaking intelligently. I think they only look at 60 days or greater and a 15% concentration. Okay. So they're a little more liberal on the delinquency rate, as far as how far behind folks are. The rate itself's the same. They're just more concerned with longer delinquencies, 60 as opposed to 30. Okay. So any condo is going to have to go through that
Right.
if, if this type of financing is going to be used. Now, all VA does is look to see if the Department of Veterans Affairs has already approved this condo for use, or if it was previously approved by HUD. And if that's the case, there's no questionnaire on VA. Okay. So
I did not
veteran
know
wants
that.
to,
Okay.
yep. If veteran wants to acquire a condo that needs work, they could technically, if the condo itself meets the VA requirement, then they could do a VA rehab on that condo. Okay. There's no questionnaire involved with VA. Okay.
Oh, wow. That's
USDA
good to
just
know.
says,
That's
Yeah, I didn't
really
know
good
that.
to know.
Yeah.
and USDA just wants to see one of them. If one of them's approved it, then they're okay with it. Okay. So
But it
VA
still
had
would have
already
to fit
approved
in the
it.
paradigm of a USDA area, like rural or
Yeah.
whatever, right?
Yeah, like Southern, like St. Mary's has some spots down there. I
Some
don't think you're going to
condos,
see
you
it
mean?
much in Charles or Prince
Yeah.
George's where a
Not
condo
not
would
in
be.
Charles.
Yeah,
Mm-mm.
no.
Yeah.
But VA, I mean, you got VA options down south, sure, and anywhere around our areas.
So how
So
does the down payment go on that? Because I know just a normal loan that's not even a renovation loan, if it's conventional, is what, 10% if it's not an approved condo. So does the renovation go the same way?
it's got to be approved in some way, shape, or form. So if somebody's coming in and putting the minimum down payment on conventional, okay, conventional regular, conventional rehab, doesn't make a difference. It's if they qualify for the 3% down, then they can put 3% down of the total cost. They qualify for 5% down, they put 5% down. It's going to require a full condo review. Okay, that full 5-page whatever questionnaire has to be completed, and everything has to be checked off. And what they call it is warrantable. If it meets all the condo guidelines, that means it's a warrantable condo. Okay. Now, if somebody's going to be an owner occupant of a condo and they're going conventional and they put down 10%, then they can do the streamline or limited condo review, which is only like 1 page, and it doesn't ask about delinquency rates. Okay.
Gotcha.
So the down payment again doesn't matter. 10% of what? 10% of total cost. So on a regular purchase, 10% of the price. On a reno, it's 10% of the total cost. And then since it's a condo, you get the streamlined review, and you don't have to worry about delinquency rates. Okay.
Gotcha. Okay.
Well, that was a lot of information, but I'm sure I know that anybody that's thinking about investing that, has that, or they found their dream home, but it needs some work. I'm definitely sure that they could use that information. Most definitely. And how would they reach out to you? How would they be able to reach out to you, Adam, to get this 203K/renovation loan?
Well, can we throw it in the chat? I can throw something in the chat, or we can have a link or something that people can follow up.
Well, what I'm going to
maybe
do, I'm going to put it on the
post.
website. It's going to be on our website, but if you could just share your number and your information now for us as well, and we'll do it that way as well.
Okay. I'm just going to go ahead and put it right here in the chat bar. So it's right here. And then
Adam is a tech guy.
I used to be a network engineer before I became a loan officer. So
410-610-4965 is his phone number.
Yep.
To the tech guy from Acela Mortgage.
And then you can also get me, you can use my Mr. 203K. So Mr. 203K at AcelaMortgagePartners.com. Mr. is spelled out. Everything's in the chat.
And Adam, we thank you so much for coming on our coffee and conversations today. You have given us so much information. Anybody that's an investor, you need to watch this. You need to take a look at this, and you need to give Adam a call to get that loan.
Not even just an investor, a purchaser as well.
Right. Can I add one more thing? Another one that this will get people thinking too, right? It's not super common, but since we're talking about reno, one of the things that folks can do and the things to understand is, like, let's look at the FHA 203K, because this is a great product for this situation. Let's say somebody has the ability to where they don't maybe have a large family, maybe they're single, maybe it's just a couple, but they want to get into real estate investing and they don't own a home. They could consider getting into multi-unit transactions or a multi-family transaction. So with FHA, you can finance up to 4 units, a residential property with 4 units. Now let's think about this from a fixer-upper standpoint and a renovation standpoint. Let's say there's an opportunity. Maybe it's a row house, or maybe it's a single family, but they want to, maybe it's got a basement that they can convert. You can use a renovation loan to modify the house. You got to follow all the zoning and whatever else is going on for that area. But in general, they could take a 1 unit and make it into a 2 or a 3 or a 4 unit property. Or if they found a multi-unit and they didn't want it, they could go the other way and say, I want to take that 4 unit down to a 2 unit. The cool thing when you're dealing with multi-unit financing, especially on FHA, as long as you live in one of the units, you only have 3.5% down payment. Okay. And any of the rentable units, you get the cash flow from that rented unit on your mortgage application. So you don't need all your personal income to qualify for that deal. You get the cash flow from the other units added to your personal income. That's the income to qualify for the loan. So you can actually jump up. And if you look at the loan limits in let's just look at, Southern Maryland, Prince George's, Charles, Calvert. I mean, the loan limits are up to in $1 million for a 1 unit. Okay. So, and they go even higher for multi-unit. Okay. So it's just thinking of different ways. If somebody wants to jump in, if they have the ability to live in a unit, they could look at trying to generate cash flow by using a renovation loan to create or modify a multi-unit property. Okay.
Very good information. Yes, that's good to know.
In conventional, you have to put much more down. Conventionally, you have to put a lot more down if you get into multi-unit, even if you live in it. That's what's great about FHA.
I have someone that's going to be calling you.
Well, then the conversation worked. There we go.
That's right.
All right.
Yes.
Awesome. Well, ladies, it's been great talking with y'all. I really appreciate you having me on. I look forward to doing this again if you'll have me back. And all you folks out there that are watching, I hope there's plenty of you. You're going to have my information. You feel free to reach out to me with any kind of questions, whether investor, experienced investor, want to be an investor, just want to get a house, and these ladies, they're going to take care of you.
All right. And so, Alicia, what are we?
We are reliable realtors
providing exceptional service. No need to go far.
Come on down
to AMR.
I love it. I don't have a jingle. I feel left out here.
You gotta have a jingle. You must have a jingle.
I got a name at least,
Yes. Thank you so much, Mr. 203K. We enjoyed spending our morning with you. It's been excellent. Great information.
Use these ladies. They're awesome.
Enjoy your day. Thank you.
All right. Bye.
Bye-bye.
Bye-bye.